Hello everyone, and welcome back to our CAIIB Risk Management series. In today's session, we're covering an important concept: risk measurement. Let's get started. Risk measurement is the foundation of any market risk management framework. It's all about using quantitative tools to understand how much risk is associated with a particular financial position. It captures how market value changes due to uncertainties such as fluctuations in interest rates, inflation, or currency values. And for that, we use two primary approaches. 1. Sensitivity. 2. Downside potential. In this video, we'll focus on sensitivity. We'll take up downside potential in the next class. So, what exactly is sensitivity? It refers to the change in market value due to a unit change in any market parameter. Let's take an example to make this clear. Suppose your portfolio is valued at 10 Indian rupees crore, and you observe that if the interest rate increases by 1%, the portfolio's value drops by 1 Indian rupee lakh. That 1 Indian rupee lakh is the interest rate sensitivity. It means a 1% change in the rate leads to 1 Indian rupee lakh change in the market value. Now, this can help you understand how vulnerable your portfolio is to interest rate movements. These are some of the key variables that can influence market value: interest rate, exchange rate, stock prices, inflation, market liquidity, supply and demand forces. Sensitivity analysis takes one of these at a time and checks how the portfolio responds. But remember, sensitivity has limitations. Firstly, it assumes only one variable changes at a time. But in real markets, multiple parameters can shift simultaneously. Secondly, sensitivity is not constant. Let's say a bond's sensitivity is 100 Indian rupees when yield is at 5%. If the yield goes up to 8%, that sensitivity will not remain at 100 Indian rupees. So, it's an approximate measure, helpful, but not perfect. In banking, sensitivity is still widely used, especially when dealing with interest rate risk. Two popular tools that help in measuring this are BPV, basis point value, duration. We'll explore both of these in upcoming videos, so make sure you're subscribed to stay updated. To quickly summarize, sensitivity helps us understand how much a portfolio's value will change if one market parameter changes by 1 unit. It's used to measure market risk, especially interest rate risk. Though useful, it doesn't account for multiple changing variables and is not a fixed value. It is still a critical part of the bank's risk management toolkit. That wraps up today's session on sensitivity as a method of risk measurement. To the continuation of the previous class, we're now diving into a very important concept from the CAIIB Risk Management Syllabus: basis point value, or BPV. This is a crucial tool used by banks and financial institutions to measure interest rate risk, especially in bond portfolios. So let's begin. What is BPV? Let's start with the basics. What exactly is basis point value, or BPV? BPV tells us how much the market value of a bond will change when the yield changes by just 1 basis point. Now, 1 basis point is equal to 0.01%. That may sound like a tiny change, but in large bond portfolios, even a 1 basis point movement can translate into significant profit or loss. So, BPV helps us measure the price sensitivity of a bond to small changes in interest rates. Why is BPV important in risk management? Now that we know what BPV is, the next question is, why do we even need it? The answer is simple. BPV allows banks and financial institutions to estimate how much profit or loss they might face if interest rates move. This is especially important for risk managers handling large bond portfolios. If a bond has a high BPV, it means its price is more sensitive to interest rate movements, and hence, it carries higher interest rate risk. So BPV becomes an essential tool in measuring and managing this risk. Can we understand this with a simple example? Absolutely. Let's break it down with numbers. Suppose we have a 5-year government bond paying 6% interest semi-annually. The current market yield is 8%, and the bond is trading at 92 Indian rupees. Now, let's say the yield falls slightly to 7.95%. As a result, the bond's price increases to 92.10 Indian rupees. So, for a 1 basis point fall in yield, the price increases by 0.10 Indian rupees. This price change may not look huge, but for a 1 Indian rupee crore face value holding, this leads to a gain of 2,000 Indian rupees. That means the BPV of this bond is 2,000 Indian rupees per 1 Indian rupee crore face value. If you hold 5 Indian rupees crore of this bond, your total BPV is 10,000 Indian rupees. How do we calculate profit or loss using BPV? This is where BPV becomes extremely useful. There's a simple formula. Profit or loss equals BPV times change in basis points times holding in crores. So, using the earlier example, if the yield is expected to fall by 8 basis points, and BPV is 2,000 Indian rupees, the profit per 1 Indian rupee crore would be 2,000 Indian rupees times 8 equals 16,000 Indian rupees. If your holding is 10 Indian rupees lakhs, or 0.10 crores, the profit becomes 16,000 Indian rupees times 0.10 equals 1,600 Indian rupees. This shows how even small changes in yield can impact the bond's value significantly when you're dealing with large amounts. What happens to BPV as the bond nears maturity? That's a great question. As the bond gets closer to its maturity date, its BPV keeps decreasing. Why? Because the bond's market price gradually moves towards its face value. On the maturity date, the bond is redeemed at face value regardless of what interest rates are doing, so its sensitivity to rate changes becomes zero. That's why the BPV becomes zero on the maturity date. So, longer-term bonds generally have higher BPVs, and as they age, their BPVs reduce. How is BPV used in real-life portfolio management? Let's take a practical case. Imagine a treasury manager at XYZ Bank. They are managing a portfolio that includes a 5-year government bond with a 6% coupon. The bond is trading at 92 Indian rupees when yields are at 8%, and it rises to 92.10 Indian rupees when the yield drops to 7.95%. The bank holds 5 Indian rupees crore of this bond. As we discussed earlier, the BPV here is 2,000 Indian rupees per 1 Indian rupee crore. So for 5 Indian rupees crore, BPV is 10,000 Indian rupees. Now suppose, based on RBI's monetary stance, the Treasury expects a 12 basis point fall in yields. The expected profit becomes 10,000 Indian rupees times 12 equals Indian rupee 120,000. So, using BPV, the manager forecasts a gain of 1.20 Indian rupees lakh. Based on this insight, they might decide to hold the bond longer, increase exposure to similar long-duration bonds, or adjust the portfolio to balance risk. What are the key takeaways from BPV? Let's summarize what we've learned. 1. BPV tells us how sensitive a bond is to interest rate movements. 2. It helps us measure and manage interest rate risk effectively. 3. Higher BPV means higher risk, and potentially higher reward if the bet on interest rate movement is correct. 4. BPV is crucial for making informed decisions in bond trading, risk management, and even regulatory reporting like value at risk or mark-to-market. 5. It also helps forecast profits or losses from expected yield changes. In short, BPV turns complex rate changes into simple, actionable numbers. If you found this explanation helpful, make sure to like the video and subscribe to the channel for more lessons on CAIIB and banking concepts.